Hi everyone, welcome to my Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Ontario, Canada. My mission is to become the Google map for hardworking Canadians seeking financial freedom. One way to achieve financial freedom is by investing in real estate. With approximately 1 million immigrants coming to Canada in 2023, and historically about 40% of them come to Ontario. Housing shortages and crazy rental increase are inevitable. Some real estate investors decide to take advantage of this crazy market. They knew that homeowners want renovated homes with updated kitchens and bathrooms. Most homeowners hate the hassle of managing a renovation project. So these savvy real estate investors buy an older home, renovate, and flip it to earn some quick cash. One of the biggest misconceptions about selling a property is that the profit is only taxed as capital gain and only 50% is taxable. Today, we're going to discuss the tax implication of flipping houses and also the top 6 house flipping tax tips that you can't afford to miss. Before I get started, make sure you subscribe to our YouTube channel and turn on the little notification button below so you can stay on top of the latest tax tips. Let's get started. Let's dive right in and look at these 6 tax tips you should remember when you do house flipping. Number 1, house flipping profits are considered income. Many flippers or renovators are often confused with the tax implication of flipping a house. Many people are under the impression that if you sell a house, only 50% of the profit is taxable. The misconception often comes in at a huge cost. If you're truly renovating a property for a quick flip, there was no intention to rent the property out for long-term investment, the profit you made is considered 100% taxable. It's 100% income. If the profit from the flip is $100,000, the entire amount is added to your income. If you own the property in your personal name, at the highest marginal tax rate in Ontario, round it down to about 50%, $50,000 goes to the government and you are only left with $50,000. If you report the flip incorrectly as capital gain, meaning that only $50,000 is taxable, CRA may even impose a penalty on top of the amount due. This can substantially increase the tax liability. Now, number 2, when house flipping, you may have to pay HST on the sale of the property. Now, the reason is that in Canada, if you substantially renovate a residential property for resale, you are considered essentially a brand new home builder. You're supplying something brand new. You need to charge HST when you're supplying a residential home that's brand new, that's considered brand new. So in that case, you may be required to charge HST when you sell the property. It is like being a builder selling a new house. You're required to charge HST and remit the amount collected to CRA, subtract the amount that you pay. You can also claim HST you pay to contractors and vendors against the amount collected. Most residential home buyers do not understand the implication of HST, and the standard purchase and sale agreement often has a box that says purchase price is inclusive of HST, which leaves the flipper and renovator responsible for the HST liability. Should CRA ever come back after you, if you're unsure whether you have substantially renovated a home for flip, make sure you consult with a real estate accountant. Now, the third tip, pay subcontractors cash without receipts does not qualify as a deduction. Contractors love to offer cash deals at a cheaper price to complete the project. As a registered accountant, I can tell you that is not worth it. I have had a few clients who pay cash for renovation, did not have any receipts, and ended up being audited by CRA. There's nothing in an accountant's power to defend you when you cannot provide a receipt to support your claim. If you choose to take the cash deal and decide not to take the deduction, be aware of the tax costs associated with the decision. For example, if you pay someone $20,000 cash to do the work for you, and you own this flip in the corporation, the cost of not deducting that expense is about $20,000 multiplied by the corporation tax rate. We assume is 12.2% in Ontario, which is $2,440. So that $2,440 tax savings by having that $20,000 properly documented deduction is what you would lose, $2,440. On top of the tax loss, you are also exposing yourself to a higher amount of risk. What if the subcontractor isn't doing what he's supposed to do and you have nothing to prove that the subcontractor wasn't doing the right amount of work? Without a proper invoice, how do you properly protect your right? Number 4, earning income through corporation would help with tax deferral and legal liability protection. Now, house flipping projects can be big or small. If it is a big project, proper insurance should be undertaken instead of just getting a regular homeowner insurance. If it is a big project, you may also be exposed to higher risk. For those of you who have followed my blog long enough, my mom's house was under renovation from top to bottom. During the renovation, there was a pipe burst in the middle of winter. Insurance eventually covered it, but the story goes to show you that anything can happen. And the insurance company is also going through all the fine prints and conditions to make sure that we are doing what we are supposed to do as homeowners to make sure that we comply with their conditions before they release the claim. But with any house flip comes risk. A corporation is considered a separate legal entity which can be used on its own. When you flip a property inside the corporation, it simply provides another layer of protection against your personal assets. Of course, if you are doing flips inside a corporation, profit from flips are considered active business income. Active business income is subject to 12.2% corporation tax rate in 2022 in Ontario. If you were to earn the same amount of income in your personal tax, you could be liable to pay taxes based on your marginal tax rate, which can be as high as 53.5%. Number 5, moving into a property for a short while to avoid paying taxes is not acceptable. When I first started out, it's very common for renovators and flippers purchase an old home, renovate it or even tear it down and build their own big mansion on the property. Move into the property for a few months to avoid tax liability. They are trying to take advantage of the primary residence exemption. They usually plan to live there for a couple of months, move back to their original home, and sell the property thinking that they can shelter the gain using the primary residence exemption. To qualify for primary residence exemption, it's a 2-step process. First, the property in question must be capital property. There are a bunch of criteria that the CRA looks at when determining whether a property is considered a capital property. One of the criteria is intention. The problem is that the intention is subjective. How do you prove that your intention is truly move into the property and occupy it as your primary residence? Some other criteria also includes whether the transactions form a part of your regular business, frequency of the transactions, etc. If your true intention is to flip, chances are you would not even pass the first test. Of course, if your true intention is to build a home for your own use, that's a different story. You are eligible to use primary residence exemption to shelter all the capital gain. Number 6, make sure you maximize the amount of tax deductions you can take and you can claim as a flipper. In Canada, you are allowed to deduct any expenses within reasons and subject to a bunch of exceptions, as always, that you incur for the purpose of earning business income. And this goes to the same as earning the income from flipping a house. Some of the most common tax deductions that you can claim and you should not miss is the following. Number 1, closing costs when you purchase a property. This includes the acquisition costs, legal costs, and any other closing costs. For example, the land transfer tax, title insurance, and mortgage broker fees if you use private lending money for your closing. So to pick up these expenses, you would have to review the trust ledger to get all these expenses picked up properly. The second deductions that you can claim is the carrying cost of the property. This may include the property tax that you have to pay, the insurance that you have to pay, mortgage interest, hydro, and any utilities, lawn care that you incur during the duration of the renovation. These are also eligible expenses that you should not miss. Number 3 is the material cost, labor cost, and also the contractor's fees. Generally speaking, you're allowed to deduct the expenses that you incur for the purpose of generating income. The direct cost that you incur for the purpose of renovating the property for a quick flip would be eligible for deduction. This can range from hiring the plumber, electrician, and buying the furnace, and also drywall, paint materials. These are all direct labor, material cost, and contractor costs that you would be eligible to claim to offset against your income that you earn. Number 4, automobile expenses. If you use your automobile or if you use your own car to the site to do the work, or if you use your own car to visit the property constantly to inspect the work, the mileage that you incur for the purpose of earning the income would also be tax deductible. Home office expense. Many flippers or renovators do not have a proper office space to handle the day-to-day. Quite often use their own home, one of their rooms, to manage the entire project. In that case, you may qualify to claim a portion of your home office expense against a profit to reduce the tax liability. Advertising expense. Advertising expenses is also the same as direct material costs. Any expenses that you incur to assist you in selling the property are considered deductible. This includes staging cost, cleaning expenses after the renovation. As you know, renovation can cause a mess. Printing signs and flyers, advertising costs on local newspaper and Kijiji, those are all tax deductible, provided that you incur the expenses for the purpose of selling the property. Last but not least is the closing costs on the sale of the property. You may incur realtor expenses and legal costs to close the property, or even an early mortgage termination charge because you're doing quick flip. These are all expenses that are also tax deductible, and you would have to pick up these tax deduction directly from the trust ledger. That's it. That's the 6 house flipping tax tips that you can't afford to miss as a house flipper. If you like this video, make sure that you give us a thumbs up. And if you have not already subscribed to my YouTube channel, make sure that you hit the subscribe button below and turn on the little notification button next to it so that you can stay on top of the latest tax tip. Until next time, happy Canadian real estate investing!